Today, we have our presentation on Delaware Statutory Trust and 1031 replacement property. Eric and I, those of you that are familiar with Eric and I, know that we have been doing presentations together for over 10 years at this point, and more than that. And I have found that DSTs are so detailed and intricate that they needed a presentation all to themselves. So I was fortunate in being able to get Stewart, our parent company, to approve this class for New York CLE credit. So I am going to begin the presentation. I am going to do the first part of the presentation, but the real nuts and bolts of this topic are going to come from Eric, who is a licensed broker-dealer selling DST interests and is really your go-to person when you want to learn more about DSTs, whether they might be a replacement property in a 1031 or just that you have an interest in investing in them without a 1031 going on. So before I begin, let's have Eric tell you a little bit about himself. And then, as I mentioned, Eric's going to handle the second part of the presentation. Eric, you're up.
Okay, thank you, Pamela, and I want to thank everyone for joining today. It's a new world, webinars. Pamela and I have done this for so many years, live presentations, but I think we can get the same point across doing it this way. I have worked with real estate investors for the better part of 20 years, primarily focused on finding suitable replacement property for a 1031 exchange. And a big part of that business is co-ownership structures. We used to do it as tenant in common, and post-financial crisis that evolved into the Delaware Statutory Trust structure. And there's a great deal of demand for this structure today. So we're happy to present this. Pamela, go ahead.
Okay. Title-wise, and who am I? I am with a nationwide qualified intermediary by the name of Asset Preservation. We are wholly owned by Stewart Title, a 125-year-old publicly traded company. I teach all the time, but the best resource I can provide you is that I am here by phone or email. If you have any questions regarding the 1031, if your clients have questions, that's what I spend my time doing, helping people qualify their deals, structure their 1031s correctly, and so forth when I'm not giving webinars. So let's jump right into the nuts and bolts of this presentation. In my portion, I'm going to talk about what is a DST, the identification rights and requirements, the extension rights that we were given on April 9th, which have limited at this point, and I'll explain why. And then how to identify a DST. It's so funny, when Eric and I gave this presentation before, I said it's very difficult, and you need, not difficult, it's very specific, and you need to make sure you understand how to identify a DST or you will get into trouble. And Eric said, oh no, it's very easy. Well, of course it's easy for Eric because this is all he does. So again, going to the right financial advisor that knows DSTs and understands the rules and understands what a client's 1031 exchange equation requires and what portion of their deal needs to be equity and debt is absolutely critical to completing a 1031 with DST as your part or whole replacement property. So a DST is the acronym for Delaware Statutory Trust. A DST is a creature of the tax code and was created in 2004 under Revenue Procedure 2004-86. They are sometimes called beneficial interests in trusts. Now, those of you that hear me speak frequently know that beneficial interest in a trust doesn't qualify because it's not real property. You own personal property. Well, Revenue Procedure 2004-86 is an exception to that. It specifies that even though an owner acquires a beneficial interest in a DST, and even though they're not directly on the deed, that they own real property for purposes of 1031. So it's very critical to understand that distinction. The documents you will get when you are interested in purchasing a DST will be very significant. Eric's going to explain what they are, but you will get a private placement memorandum and a lot of disclosures. And why? Because even though these interests are considered real property for 1031 purposes, they are considered security for security law purposes. So Eric has to cross a lot of T's and dot a lot of I's. Okay, so just a brief outline on how the DST comes into existence. The trustee initially purchases a property, and as Eric is going to tell you, the trustee / sponsor in today's world is most of the time a very significant institutional-like entity that has a very long track record in real estate. So the trustee and/or sponsor will go out and purchase a piece of real estate, and they arrange for the financing to purchase the real estate. And usually in these trusts, and again, Eric's going to be more specific about this than me, there is more than one real estate. There may be 3 multifamily buildings in one trust. But when the sponsor opens up those interests for sale to 1031 and other investors, the property is already purchased and the financing's in place, which is why it makes it so convenient. One of the reasons it's so convenient for a 1031 investor, because you don't have to run around on your own qualifying for the financing. Eric's going to also explain that these interests can only be sold to accredited investors, and how he defines an accredited investor and how he assures that the person he's working with before he gets too far at the gate is an accredited investor, because if you're not, at the entity or individual level, you won't be able to make this purchase, and you're spending your identification period, you're wasting it. And as we know, in a 1031, your identification period is generally 45 days, and it runs very fast. Okay, so the sponsor also arranges for property management. And as I mentioned, the sponsor is going to provide the private placement memorandum, and this PPM provides information on the property, demographics, leases, tenants, financial projections, and so forth. And the DST can have an unlimited number of investors. Remember, before the last recession, those of you that have been in a career since then, which some of you are, that's 10 plus years ago, so some of you might not have been around then. But when Eric and I used to speak back then, we weren't talking about DST, we were talking about tenants in common. And tenants in common proved to be a very unruly structure and very limiting when you got to having management problems or issues with the real estate. So after the real estate disaster of 2008, 9, 10, the techs no longer really exist on the large-scale offering platform. That's all been switched to DSTs, and it's because there are so much. DSTs is a much more convenient vehicle to offer these interests, much more convenient to manage the real estate, and also much more convenient for the individual investor. And Eric and I are both going to highlight why that is the case. So the next slide really talks about the difference between the former TIC structure and the DST structure. And I'm not going to spend a lot of time on this because really this TIC structure is not around anymore. You'll see maybe 3 brothers getting together and forming 3 LLCs and buying a piece of real estate together as tenants in common. You will see that, but you won't see this with hundreds or 30, 40 investors in the deal. The structure that is now used is a DST. One of the advantages is that you do not receive a deed. You get a certificate, so there's not a lot of recording going on. DSTs are very fast close. Whether you think this is a privilege or a disadvantage, you as a beneficial owner have no voting rights. You do not get to determine what happens with the property and who you lease to and so forth. You are truly a passive investor, which to most is a tremendous benefit because you have an institutional-like sponsor that's managing the property. Okay, so I want to dive right into how, if you're pursuing a DST in a 1031, what you need to do. Well, if all you're going to buy is DSTs, and if you have lined up and are working with Eric, it is likely that Eric will have in place for you the interest that you want to buy, even before you've closed on the relinquished property. But certainly he's going to have those interests lined up within your 45 days. So where you're only buying DSTs, my experience as a qualified intermediary is that you don't need to identify. And why is that? And by the way, these rules are painful if you've done a 1031, you know that. Whatever you close on in your 45-day identification period is deemed identified. So back up. When you are buying DSTs and that's all you're buying, it's likely Eric's going to have them lined up for you and you're going to close on them very quickly. So you will be done within your 45 days and you don't have to go through the painful ID process. Now, switch gears slightly. Let's say we have an investor who is going to buy some DSTs but also wants to buy some real estate straight out solely in their own tax owner name without a DST. So they want to buy, a small commercial building. Maybe they've got a $10 million exchange. They're going to buy the commercial building with $6 million and they want to put $4 million into a DST. So what's the problem there? Well, the tricky part, one of the tricky parts is if we've closed on our building within the 45 days, it's fairly easy because we know what we've spent. And then we can put the rest of the bucket into DSTs and identify only DSTs. Now, that does not mean that that building is not considered identified for the purposes of these rules. That would count as one property. Then you might identify DSTs as the remainder property, and you would still probably use the 200% rule. Why? Because, as Eric's going to mention, most DSTs own multiple properties. And each property counts as one for purposes of the ID rule. So if you are buying a DST into a DST that owns 3 buildings and you've already bought your own building in the 45 days, you're going to be needing to use the 200% rule. Okay, even though you don't have to necessarily list that building that you already closed on in your ID, you have to list the DST. And we're going to talk about how you identify those 3 buildings owned by that DST. But each one's considered one property. So that is still a manageable situation because we closed on our building in the 45 days. We closed on everything we knew we wanted to buy separate and apart from the DSTs in the 45 days. But we did not close on the DSTs yet because we're waiting to see how much money we have left over, how much value we have left over. So, but we've got a finite amount and we know what that is. So we know what we're telling Eric, hey, we need to buy $4 million worth of DSTs. Let's get them on the list. But what happens if you haven't closed on the property, that building that you're going to own 100% of in your identification period? So now we're at the point we need to identify, what if the building falls through? Then we've got $10 million that we really need to place all in DSTs. Here's what I said, strategies. Close within the 45-day period as extended. And I'm going to go back to those extensions momentarily. Revoke a pre-existing identification and re-identify within the extended identification period. Identify one or more DSTs as a primary identification or as a backup on or near the end of the ID period, and exercise caution to ID proper percentages, especially if a backup. Okay, so in my example, we haven't closed on that building. We're not sure if we're going to close on the building. So it is likely you're going to have to identify in the alternative, and this is where you need someone like Eric with the expertise he's got, because You need to probably use the 200% rule, not probably, you will. And is there a way to identify in the alternative so that you have property on the list sufficient to absorb all of your value in the case that you don't buy that one building or aren't able to buy the one building? That is the question. And when you identify a DST, you identify an undivided fractional ownership interest in the DST. And that fractional ownership interest is what you're measuring for purposes of the 200% rule. So, each of the properties owned by the DST counts as one. If that DST owns more than three, if you're going into one DST and it owns more than 3 buildings, or you're identifying another DST as well, or another property, you must use the 200% rule. To identify a DST, you're going to identify the percentage interest, the DST name, the legal description and street address, and attach a schedule. So each building needs to be identified. Now, let's say you're going to buy a 5% interest. Well, that is the value you're using for purpose of the 200% rule. The DST probably owns 2 or 3 buildings worth $20 to $40 million. So it's not that 20 or 40 million that you're counting, obviously. It's your fractional ownership interest. But for purposes of the exchange equation and for purposes of identification, your fractional interest is not just the equity you're putting into the deal. Most of these DSTs are leveraged. So let's say you're putting $1 million in of equity to a DST that's 50% leveraged. That means you're buying a $2 million piece of the pie. So for purposes of the 200% rule, the value of that particular interest would be $2 million to determine if you have exceeded 2 times the value of what you have sold. Your identification has to be in writing. It's got to be hand delivered. It's got to be in our hands by midnight of the 45th day, and it needs to comply with one of these 3 rules, or you will be disqualified on audit. It is not easy if you're identifying the DSTs as backups to identify them in the alternative. So again, working with Eric well in advance is going to be very important. Now, the extensions that I have been referencing, let me mention very briefly. If you had a deadline, a 45 or 180-day deadline that fell between April 1st and July 15th, 2020, your deadline was extended by this notice to July 15th. So if you've already closed and your closing was, let's say, April 15th, your 45 days would have been gone, but it's not, because now you have till July 15th to identify. So if you already identified, which you may have done because these notices came out on April 9th, and if your ID was due before then, you would have identified. Or even if you identified after April 9th, you still have the ability to revoke and re-identify. Maybe things aren't going so well. I mean, you know, what's going on in our world today is a first for everyone. And so what you may have identified a couple weeks ago may not look so good. So what I'm trying to make sure everyone understands is that if your 45 days, the original time period, runs between April 1 and July 15th, even if you've already identified, you can revoke and re-identify. Likewise, for those of our exchangers whose 180 fell within that period, they didn't have to close on their 180th day. They actually have till July 15th to close. Now, this extension is of far less import now than it was a month ago when I was giving this seminar. And the reason is because let's just count the days. Someone closing today, their 45 days is after July 15th. So this is a moot issue if you're closing now. But there's still a lot of people whose deadlines fell in this period of time who can benefit from these extensions. And I want to make sure everybody knows that the revocation rules and privileges will apply and do apply to those people whose 45 days ran in that period. There's some examples here that I can let you read on your own, but I just wanted to make that emphasis today. Now, the one other point I want to make here is you're going to hear some people making reference to, oh no, you have 120 days after your deadline ran. That is the typical case when the IRS issues an extension to the rules. The 120 days is provided for in Section 17 of Revenue Procedure 2018-58. This notice that we got, 2020-23, made no reference to Section 17 or the 120 days. It referenced only July 15th. So it is our belief that July 15th controls. Now, if you cannot meet that deadline, then I recommend you see a tax attorney and see if your tax attorney and your CPA may be comfortable hanging their hat on the 120 days, even though the statute or the notice made no mention. Because I do have some tax attorneys that feel there's some kind of basis for allowing for the 120 days. It's just not the conservative view. Okay. When we buy replacement property in a 1031, we have to trade up or even in value, with our value being the contract sales price, less only exchange expenses. For more on this, you should really come to one of my other webinars, because I don't go into the exchange equation heavily in this presentation. But I do want to emphasize that the reason DSTs are so great for investors doing a 1031 that need to replace debt, as Eric will emphasize, that debt is already in place on the DSTs. So it's just a matter of determining how much leverage you need and lining you up with the DST that has that amount of leverage, or possibly more if you're good with trading up. Okay, I have one example here that I mentioned because of the DST situation. So here we basically traded, we have a perfect exchange. We spent our equity and spent our debt. In this case, the taxpayer invested $1 million of equity in a DST that is 50% leveraged. So that 50% leverage automatically replaced your $1 million of debt. So this results in no boot and is, a fabulous solution for a 1031 investor. Okay. In the second example that I have on the screen, the taxpayer invested $2 million of equity in a DST that is 50% leveraged. Okay, so what does that mean? They only had to spend $2 million, but the DST is 50% leverage, so now they actually bought replacement property and traded up, because they're getting also $2 million of debt that they didn't have on their sale. So their replacement property is a $4 million value. And that is the value you're going to use for purposes of the ID rules when you're trying to see if you meet the 200% rule. Because it's actually the $2 million you're putting in plus the $2 million of debt. Okay, so what else about DSTs makes a DST option particularly wonderful in this day and age and time? We can't get out of our apartments. Nobody goes out and looks at Eric goes and looks at the property, but nobody else goes out and actually looks at the buildings in Georgia and Florida and Texas that the DST owns. So, second, your 45 days, even if extended, goes very quick. And as I've mentioned, these DSTs provide very quick closings. The paperwork is pretty much non-existent. You don't have all of the documents that a lawyer would have to deal with to close a regular real estate deal. I've mentioned ad nauseum that they can be customized to meet your exchange equation, and you don't have to be there in person. So I managed to get my half done in 30 minutes. And now for the more interesting part of this presentation, I'm going to turn it over to Eric.
All right. Thank you, Pamela. Okay, so a couple of things I should have mentioned when Pamela gave me the opportunity to introduce myself. These DST offerings are a securitized product. So I have two different securities licenses. I'm a registered representative and also an investment advisor representative. We work under the capacity of the registered representative when offering these Reg V private placements. I'm also a real estate licensee in the state of New York. There are instances where sometimes we will work with a direct real estate purchase in conjunction with the purchase of a DST for, diversification. One of the things I want to do before I jump into the slides, because I really don't have a slide that's going to touch directly on the ID process. Pamela really spoke a lot about it, but this July 15th deadline, this extension is really about the practical purpose of identifying your property with your qualified intermediary. People are locked down in different areas. Not everyone is set up to work from home. Not everyone has the technology to do this. So the IRS said, we'll give you more time to identify your property. The reason why I'm bringing it up is this. If you think you're going to see different opportunities by July 15th, that's more of a stretch, okay? The sponsors that I'm working with, any offerings that are available now, and even a new offering that might come out this week or next week, is something that was already in the works pre-COVID-19. So thinking that you're going to get an extension to July 15th to see if a new opportunity comes out, a sponsor is not going to have the time to take advantage of any opportunity that might arise now. It takes time to put these deals together. So the July 15th deadline is really about identifying, giving you time to identify correctly, not necessarily finding new opportunities. I'll get into the sponsors and the deals, that could be available for people in the immediate future and how that might change moving forward post-COVID-19. Pamela's helping me out.
We have a couple questions, and I was going to highlight them so you hit on them. It's, will you discuss exit strategies from a DST? I know you're going to talk about exit strategies, Eric. So that was one of the questions. And then the next one is, be interested in learning 1031 to 721 exit strategies. Actually, that we mentioned in yesterday's seminar. So Michael, I will get with you separately on that issue.
So the Delaware Statutory Trust, Pamela mentioned, what happens is a real estate investment company, an established real estate investment company, will acquire property that would qualify for 1031 exchange. It's an investment property. It's usually an institutional grade investment property, something on a scale that an individual investor would typically not be able to invest in standalone. So they'll buy that property, either all cash or with debt. They'll arrange the financing, and then they'll put that property into the trust. And then they will issue beneficial interests in that trust to individual investors that are completing a 1031 exchange with varying equity amounts. You could have hundreds of investors in a DST investment. So the Revenue Ruling 2004-86 essentially said the IRS will recognize that beneficial interest as direct ownership of the real estate that the trust owns. So it's not a gray area, it's black and white. It's a co-ownership structure, it's a passive investment. Rights and obligations of investors are governed by the trust agreement, and the investors have limited voting rights. So essentially, you're investing with this sponsor, and you're relying on that sponsor to manage this asset for you and deliver the projected income. Okay, so if you're at a point in your life as an individual where you're looking to be more of a passive owner of real estate and you're tired of the management responsibilities, that's the first question that we ask of a potential investor. Do you manage your own real estate? Are you okay being a passive investor? Because you don't have that voting right. And the voting right is really, really important. I'll tell you why. Being one of only a handful of advisors that were working in this business before the financial crisis, we did the deals as tenant in common back then. 35 investors who didn't know each other, all on title. They had to individually get approved for the loans. It was tough. But it got even tougher when property values started to crash during the financial crisis, and sponsors needed to do workouts. They needed to refinance. They needed to sell a property, get a new tenant, whatever the case may be. With tenant in common, you need 35 investors to all agree unanimously. It's difficult. People know this. It's difficult when you have you and two relatives own a property together sometimes to get everyone to agree. Imagine 35 investors that don't know each other. So in my experience, what I've learned is this: if you are at a point where you're ready to be an investor passively in a co-ownership structure, the Delaware Statutory Trust structure is much better than the tenant in common structure. Because with that tenant in common structure, you can end up with an unsophisticated investor with a voting right and ruin the deal for everybody. With the DST, you work with quality sponsors. That's your number one priority, and you let them run the deal. And if you're not comfortable with that, then it might not be an investment for you. Okay, so the sponsor, real estate investment company, will act as the trustee. They acquire the property, obtain the loan. If the deal is leveraged, property is deposited into the DST. Sponsor issues those beneficial interests. The sponsor is the overarching asset manager, and an affiliate of the sponsor, or the sponsor, if they have that, will be the property manager at the property level. The DST may own a single property. It may own a portfolio of properties. It may be leveraged. It may be all cash. So a portfolio of properties, we like that idea conceptually, because it gives you instant diversification with the stroke of a pen. If a DST owns 5 properties, you could be invested in 5 different properties in 5 different geographical areas. I'm going to touch on something because Pamela mentioned one of the questions, and that was the exit strategy for the DST. And I bring it up at a point where I'm talking about the multi-property DSTs. So essentially, again, it's a passive investment. You're relying on the sponsor, right? They've acquired the property. They're managing the asset. They're going to sell that property at their discretion. And when that happens, you're going to receive the sale proceeds just like you would from any other sale. You're going to take the sale proceeds if you want to do another 1031 exchange and deposit with the qualified intermediary. And you're going to either do your own exchange. You're either going to roll into another DST with that sponsor or another DST with a different sponsor, or you can take your money back and pay your tax. But I think the question was really about what's the exit strategy. Well, there'll be a plan. And the sponsor will typically have a 10-year plan, and that's usually tied to the loan term. So they want to be out before the end of the loan term. And if it's a 10-year loan, maybe 5 years interest only, 5 years amortization, they're looking to sell in year 8 or 9. Historically, we've seen them sell sooner, but the market's different now. And I caution people that are getting into DSTs now to plan on holding the property toward the longer end of the range, maybe 8 or 9 years. You're not gonna decide when to sell it. Are they liquid? You can sell your interest. Doesn't mean they're liquid. There's no secondary market. If you have to sell, the sponsor will help you. You'll probably get 70 cents on the dollar. So if you go into this deal looking to park your money for a couple of years, not a good idea. Go into the deal with the sponsor, with their plan, with their projected holding period. Some of the sponsors do one property deals, and we like that too because it gives me, the advisor, an opportunity to work with the investor. We create our own portfolio, okay? We pick and choose the properties, and we can create our own diverse portfolio. Okay, got the next slide. So the sponsor will be entitled to fees and reimbursements as set forth in the trust agreement. So look, this is an investment product. It's a securitized product that has to be brought to the market. There's a cost in doing that. If you're a passive investor and you have no other obligation, to run that property or manage that asset in any way, there's a cost to doing that. Understand what the costs are. This is where you rely on the investment advisor who is guiding you to break down the fees, understand what you're paying for. Okay, what we look for as a broker dealer when we're vetting a deal, we look for the total offering amount, which is the property as it was acquired, plus any acquisition fees and any fees at all that are required putting that deal together. Now we have a fully loaded purchase price, and we want to look at that cap rate, and then we want to see how that compares to other direct real estate purchases. And that's a good way to get a gauge of how the fees are going to affect that deal. So are the fees negotiable? That's a great question. That's going to depend on the broker dealer and the advisor that you're working with. They are not negotiable with the, I see that other question. They are not negotiable with the DST sponsor, okay? You may get an advisor to work with you on the fees. Typically, if someone's doing a larger deal and they're doing their whole exchange with me, and there's an incentive there to work with that client to try to give them a little bit of a better deal if we can do it, So you're probably only going to be able to negotiate at the level of the commission that the advisor would receive. So look, I'm just going to address questions as they come up. I saw that other question come up, and this was about zero coupon DST. So let me get into that, because I don't have a slide for that, so we may as well touch on that for that particular person. Zero coupon deal has no cash flow. It's a highly levered deal. One of the top sponsors in the business is Inland Private Capital. They are the top sponsor in the business. Do a lot of business with them, okay? So to be highly leveraged, like 85%. So there won't be any cash flow. So what's your return on that? Your return on that is the amortization of that debt. So that loan will likely be what they might call something like hyper-amortized. It might be a 25-year amortization period, and it'll amortize immediately. Whereas, like if it's a multifamily property in a traditional DST structure, you would probably have like a 10-year loan, like I said, 5 years interest only, 5-year amortization, and that'll be based on a 30-year amortization schedule. So with the zero coupon deal, you'll get a return based on how the loan is paid down. If they sell the property in 10 years and you were paying off the note for 10 years, there'll be equity building up in that deal. So why would you do a zero coupon deal? Well, different investors have different needs. When it comes to covering the debt for your 1031 exchange and getting a full tax deferral, you might find a property that you like, or you might find a DST that you like that just doesn't have enough debt to cover your debt obligation for your 1031 exchange. Let's just say you come out, you're 60% leveraged coming out of your deal. I show you a DST investment, it's 45% leveraged. There's a shortfall there. You can add money to that DST deal. You'll assume more debt by doing that. Or you could take a little piece of like a zero coupon deal and cover your debt obligation that way. You might find something on your own, all cash, that you purchased directly. You didn't cover any debt. You come to me, I can get you into a zero coupon deal that covers your entire debt obligation for your 1031 exchange. People that do the zero coupon deals aren't looking for the cash flow. Most of the DST investors are looking for the cash flow. Zero coupon, no cash flow. Your return is the equity buildup, but it helps you to cover your debt. And I'll tell you this, if you go do a zero coupon deal on your own, you better know what you're doing, and your accountant better know what they're doing, right? And you better work with your tax advisor, because there's all kinds of issues with potential phantom income. And at the end of the day, at the end of the lease, what you might owe in taxes. So if you work with a sponsor that knows what they're doing and the deal is laid out for you, you can take that, show it to your accountant. You don't have to worry about how things are going to turn out. Okay. Debt is non-recourse. If there's a debt requirement as part of the 1031 exchange, the DST debt qualifies to cover that debt. So non-recourse debt, you don't qualify for the loan, you don't apply for the loan, you're not liable for the loan. But do remember that when you have debt on a property, you have risk, right? If the property failed, it's great that it's non-recourse debt for you. However, you're forgiven on that loan, and that is a tax consequence, right? Loan forgiveness is income in the year that you were forgiven of the loan. So it's not, completely without any consequences just because it's non-recourse debt. Okay, so the investor receives income from rent revenue, net of all operating expenses and debt service, and it is only going to be income from rent revenue. So let me explain this. Right now, we're going through some issues with this COVID-19 crisis. One of the better sponsors in the business had to make some adjustments to the cash flows on the properties because rent collections were not 100%, as we might guess, right? I actually think it's very prudent and very responsible of a sponsor to adjust cash flows on a real-time basis based on the income that's coming in, rather than try to rob Peter to pay Paul just to kind of float the deal and keep the cash flow the same and keep everybody happy. You're digging a hole for the property that you can't get out of. All right. So the income comes from the rent revenue. It's not going to be a return of your own money. It's not going to come from the reserve account. It's not going to come from any other properties, nothing like that. That property, that deal, that rent revenue. Depreciation and mortgage interest deduction pass through to investors. So you get all the tax benefits that you would get if you were a direct real estate owner. Investors receive a substitute 1099 or a profit and loss statement. You don't get a real 1099. It's not something that's provided to the government. They called it a substitute 1099 because it's structured that way. It's very easy for the accountant to look at this document and see how to, do your taxes from that. No K1 either. It's not a partnership. It wouldn't be a 1031. Projected annual income typically ranges from 4% to 6.5%, something in that range, right? So the higher quality, the tenant, usually the lower the income. It kind of works like that, right? I tell people don't go chasing yield. Deals that are in that 6.5% range might have some hair on it, more or less. You got to be careful. Look, a lot of this product is sold on the internet. To me, you work with your advisors, your CPA, your attorney. Most of my referrals come from CPAs and attorneys. It's not something you go Googling looking for property to replace your 1031 exchange. And I'm speaking a little fast. I apologize. I just want to make sure that I get done, in case there's any other questions as well. All right, certain prohibitions as described by IRS Revenue Ruling 2004-86. This is really, really important. This is where you have to work with a good quality sponsor with an extensive track record. They need to know what they're doing. If you don't follow these IRS rules, the IRS could disallow the exchange, disallow the DST. No capital contributions may be made to new or existing beneficiaries by new or existing beneficiaries after the offering is fully subscribed to. So the property or properties or the deal will have a reserve account, enough of a reserve account to take care of that property for the projected holding period. You're not going to get a phone call as an investor, property needs a new roof. We have to, assess people and raise new money. No, you can't do that, not allowed to do that. It's actually not a good thing if a sponsor had to raise new money. It means something's not going right with the property. The DST cannot renegotiate its existing mortgage debt or enter new or replacement mortgage debt unless a property tenant is bankrupt or insolvent. So let's talk about multifamily, because your tenant's not going to be bankrupt or insolvent. You're going to have one master tenant, which is the sponsor. And once they put that loan on that deal, that's it. There's no renegotiating. So that's why you got to deal with a good quality sponsor that can manage that asset for that projected holding period. Because you get into an issue where you do have to refinance, you got to take the property out of the DST, you got to put it into an LLC. They call it a springing LLC. It's not good. It means something wasn't being done right. And you could lose your ability to 1031 exchange out of that. Some sponsors say you can put it back into the DST. I don't know. It's something that's debatable with the IRS. But for the most part, think the loan is in place. That's the one loan you're going to deal with, and the property will be sold before that loan comes due. The DST cannot renegotiate existing leases. So we used to see in the beginning a lot of like single tenant lease deals in DSTs. But it works with the multifamily again because you have that one master tenant, the sponsor, and that's one lease. And the sponsor is subleasing to the individual renters. So you have that one lease in place. The trustee cannot reinvest proceeds of the sale of its real estate. So this is not a REIT. REITs buy and sell properties all the time. When that DST is formed for that particular property or group of properties, that's it. That's the one entity for those properties. When those properties are liquidated, that DST ceases to exist. Going back to that person's questions about question about liquidation. If you have multiple properties in the DST, there's no guarantee they're going to sell them all at the same time. They'd like to, they'll try to, but they might come out one at a time. You're going to end up with smaller equity bites when that happens, and more than likely you'll end up rolling into other DSTs because of the size of the equity that comes out of a multiple property deal. Capital expenditures may only be made for normal repair and maintenance or improvements as required by law. You're not going to see any kind of a You might see a light value add deal. You can't make structural changes. You can only do upgrades, lighting, flooring, parking lot, things like that. So it's very limited, and you'll typically see newer properties for that reason. You may see a light value add. What's a light value add? Maybe a 12-year-old multifamily property that's showing its age. So there are below market rents in place, and sponsor will come in with a larger reserve account. They'll do some upgrades and start raising rents, and they can add value to the property that way, but it would be a light value add. All cash between distributions can only be invested in short-term debt obligations, and all cash other than reserves must be distributed on a current basis, so every month. There are a couple of sponsors that do make quarterly distributions. So those are your 7 rules. The sponsor has to adhere to these rules. If they do not, the DST could potentially be disallowed, So what are the DST benefits? Obviously, you can do a 1031 exchange into a DST, in or out. But the reason why that says in or out is because you can make a cash investment into a DST without doing a 1031 exchange. Why might you do that? Well, maybe you like the property. I can tell you the advantages. The cash flow, like I said, somewhere between 4 and 6.5%, but it'll be 100% sheltered. You'll get all the depreciation. With a 1031 exchange, you're working off the depreciation schedule from the property that you relinquished, right? When that's done, it's done. You don't get new depreciation unless you buy more property than what you're exchanging. If you come into a DST with a cash investment, you're likely to have, for the life of the program, 100% sheltering. Then you can 1031 out of it, and you don't have to recapture that depreciation. What if one or more tenants start to default and the DST is transformed to an LLC? You can get the rest of that question. How are investors impacted? All right. So one or more tenants are defaulting on their leases, so the income is drying up. How are investors impacted by that? So you're going to have less income, and they will probably adjust the cash flow to reflect that reduction in income. Now, if you have debt on the property and they can't meet the debt obligation, you have a real problem, right? So they'd have to get a new tenant in there real quick that can pay that rent. Again,
Eric, mention about the amount of leverage that most of them have, because way back when, okay.
Prior to the financial crisis, we would see 65, 70% and higher leverage on those tenant in common deals. That was just too much to overcome when you got into that crisis situation. So a lot was learned from that. So most of the deals we see now are right around that 50% area, sometimes a little less, sometimes a little bit more. That's not a lot of leverage for a commercial deal, typically, right? But it still adds risk to the deal. So your real risk would come in if the debt service could not be met. That would be a real problem for the investor. That would be a situation where, you could lose all your equity in the deal and still owe your tax. It could be bad. So it's important. It's a good question. I'll tell you why. It really hurts me sometimes when I see the way these deals are sold, especially with the internet and everything. And advisors, air quote advisors out there, aren't explaining to people really what they're getting into. You're making a real estate investment. If you go buy a property down the block and it's a four unit multifamily property and 2 of the tenants leave, you're going to have less cash flow, aren't you? It's the same thing in a DST. So it's a real estate investment. You have to be prepared for that. So we can 1031 in and out of the DST. We can customize to meet the exchanger's equation for their 1031 exchange. This is real easy to do. And I know, Pamela, I say that because, again, I've been doing it for a long time. To me, it is easy. We work with a spreadsheet, and whether you're adding a DST to some other investment properties that you're buying or you're doing all DST, we can really tailor this thing to meet your debt requirement, meet your income requirement that you're looking to meet, and get 100% deferral on your exchange. Another great way, probably on the next slide, to use the DST is to fill the gaps. I got a great call the other day from an investor with a $36 million deal, and he ended up finding a property, but there may be a couple of million left over, and it's something that they could look for DSTs to fill that gap. So you have a quick close, you have surety of close. There's no guesswork. Biggest problem with a 1031 is you identify something, you go through that due diligence process, your 45 days expired, something comes up during that due diligence process that prevents you from wanting to do that deal, you're out. That's it. When we recommend a DST and I get that reservation for you, once we get that paperwork in, you're done. That the sponsor owns that deal and you're an investor. So there's no guesswork or ifs about that. I spoke about filling the gaps. That's huge. I see a lot of that. And the exchanger does not need to qualify for the financing. So look, what's the problem right now? I mean, I'm talking to sponsors out there, and the reason why we're not seeing a lot of new deals at the moment is the financing is all frozen at the moment. And you know, if you have a deal with financing in place, you don't have to worry about that. Okay. That could be huge. That's a big post-COVID-19 issue there, the financing. All right. Geographic diversity. That's great. You can do that with multiple DSTs or the multiple property DSTs. And it's a prepackaged program. So essentially, we provide you with that PPM. It's 300 or 400 pages. We get another 600 pages of due diligence to look at. So a lot of due diligence is done on these deals at the property level by the sponsor, by the bank if there's a loan, and by the broker dealer, which is my company, which has to vet the deals too. So let's wrap it up with a word about the sponsors. And one thing I'll say, though, is that I am working on a series of DST presentations that will be more DST specific. They won't qualify for credit. There have been some challenges for me with getting these approved by compliance because you're dealing with you know, the webinar now, it's different than when you just had gathered people around for a chat about it. But we will get into more details and we will invite people that attended these presentations to those DST specific presentations. So look, I've got 2 decades of experience working with real estate investors on these deals. I've learned a lot. I'm one of only a few guys that have been doing it since before the financial crisis. Many of the people out there selling these things all over the internet, they were in high school, you know, when that was going on. And the things that we learned, believe me, it's a big help right now in the midst of another crisis here, right? There were 100 sponsors before the financial crisis happened. There were 3 left standing. I've done hundreds of millions of dollars in equity with those 3 sponsors.
I want to say thank you to everybody. Now, I'm going to be emailing this presentation out. And so anybody that has additional questions for Eric can email or call Eric, ask any questions that we did not get to. So you see Eric's information here.